Hello everyone, welcome to this podcast from National Institute of Securities Markets, popularly known as NISM. NISM is SEBI's educational initiative. I am Kunj Bansal. In today's podcast, we will talk about India's macroeconomic status, growth rates, positives, negatives, and all other associated details. To start with, let us refresh the environment that today we are in. As we all know, today we are in a very high inflation environment. And why this has happened? This has happened because of the easy money policies adopted by central bankers all over the world. That obviously was a forced decision because of the slowdown brought in by corona pandemic. Now what happens is that easy money availability almost invariably results in inflation, and which is where we are today. Globally, the inflation is rearing, or rather has reared its ugly head. To control inflation, there is only one single tried and tested, well experienced method of increasing interest rates, and which is what is being done everywhere. US Fed has increased its interest rates from a level of 0 to currently a level of 4.75%, which is a sharp hike of 475 basis points in hardly 15 months. Coming to India, almost the similar situation exists here as well. Consumer inflation started raising its ugly head somewhere in the last quarter of 2021. RBI had to take a note of it and started increasing interest rates. It increased interest rates from a level of 4% to currently 6.5%, which is an increase of 250 basis points in a period of less than 12 months. This is too sharp a hike, and that too in a short period of time. Obviously, that is what has its impact on controlling inflation. This kind of hike is clearly visible in the slowdown globally as well as in India. In India specifically, this slowdown is visible in the reduced sales of two-wheelers, reduced sales of consumer goods, and reduced sales of consumer durables. Globally, this slowdown is having its impact on reduced growth rate of India's export. As we can see in this chart, that growth rates of India's exports have been clearly coming down. Interest rate hike is also probably the reason why India is witnessing continuous outflow of global money. As we can see in these charts, India has witnessed a net outflow of global money from both debt as well as equity market. These three factors put together, interest rate hikes, reduced export growth rates, and global money outflow, has obviously had its impact on the Indian currency. As we can see in this chart, Indian currency has depreciated by 10% in last 1 year against the US dollar. That's a sharp fall. But is everything negative? Probably not. While India is having its dark spots, it certainly has bright spots as well. Let us look at some of them. To start with, in these charts, let us look at the Purchasing Managers Index numbers, more popularly known as PMI numbers. The services PMI number has been continuously remaining above 50 for last quite few months. So what does it indicate? Any PMI number above 50 indicates expansion, while below 50 indicates contraction. So as I said, the numbers have continuously remained above 50. That clearly indicates expansion. Moving on from services PMI to manufacturing PMI. Similar is the case here as well. The manufacturing PMI numbers have also remained above 50 for last quite a few months. So these are positive signs. Let us look at the credit growth. Credit growth in India has been around 15% for last quite a number of months. Just to put this in perspective, the same growth rate number was around 6% in large part of 2021. So that's the kind of growth that money demand has been seeing in India. Somewhere probably increased economic activity is the reason for this kind of credit growth. Ultimately, all this data flows into the GST collection numbers. And as we can see in this chart, GST collection numbers have remained above rupees 1.5 lakh crores for last 12 continuous months. On inflation, while we don't have the support of consumer price inflation coming down, we certainly seem to have the support of wholesale price inflation. Wholesale price inflation has started to come down and has been below 5% for last few months from the double digit number that it used to be earlier. As we saw that we don't have support of the global inflows, rather we are witnessing global outflows, but we do have a big support of domestic inflows coming in the market. The chart shows the money inflow that has happened from domestic investors in the Indian market. So that is another positive sign. All economic activities ultimately feed into the GDP growth rate numbers. The GDP growth rate for India for financial year ending March 23 is expected to be around 7%. This number is expected to fall marginally down to 6% for the next financial year ending March 2024. While this 6% number certainly is below the 7% number for FY23, but put together, these two numbers of 6% and 7% will be amongst the highest growth numbers in the similar sized economies all over the world. Despite some slowdown, India's corporate sector has been witnessing continuous growth. As we can see in this chart, the EPS expectation for Nifty over the next few years are showing a continuous rise. The expected EPS for financial year 2023 at about rupees 800 is almost a 10% rise from the last financial year. And it is expected that in the coming years, the growth rate will hopefully be higher than the 10%. In the last 1 year, Indian equity market has largely been flat. As we can see in this chart, that Nifty showed a marginal gain of 3% in the last 12 months. The interest rate hikes invariably have an impact on consumption demand. So we might continue to see some slowdown in the consumption demand. For the same reasons, we might continue to see exports remaining low. Geopolitical challenges, which are continuously there across the world, could keep oil and other commodity prices volatile. And that could be the other check on India's growth rate. On the positive side will be factors like expected softening of consumer inflation, which is likely to result in increased demand. Continuous capital investment by government over the last 3 years and recently supported by the private sector will likely result in multiplier impact, leading to higher job creation, in turn leading to higher consumption demand. The savings in operational and logistic costs due to the improved infrastructure of roads, highways, ports, etc. will certainly add to this overall positivity. Not to forget the effects of increased digitalization and automation that will come in improved productivity of the corporate sector. The older reforms of GST implementation will continue to impart their benefits in the overall working of the economy. So on a net basis, despite some hiccups in the short term, it is likely that India will continue to have a steady growth in the medium term. This brings me to the end of today's podcast. Hope you enjoyed it. Thank you for your patience and thank you for listening. Please do share your feedback on the email provided in the attached slide. You can of course get in touch with us at our various social media handles shown here. Look forward to seeing you in the next podcast, wherein we'll talk about some similar data and happenings in the ongoing environment for India. Till then, stay tuned. Thank you very much.